Get Rich Education is brought to you by Norada Real Estate Investments and Mid-South Home Buyers.
Welcome to Get Rich Education with Keith Weinhold, giving you information and ideas on the investment that has turned more ordinary people into millionaires and billionaires than anything else, and can provide you with more wealth and happiness than you ever thought possible. Now, here's your host, investor, entrepreneur, business owner, and educator, Keith Weinhold.
Welcome to Get Rich Education, episode 56. I'm your host, Keith Weinhold. Here's hoping that you've lived an abundant week. Over time, do you want to own more cash flowing income properties or less? If you're here, the answer is likely more, okay? You can control more properties with loans where you're using as little money as feasible for your down payment and closing costs. In real estate investing, in an appreciating environment, great returns can come from leverage. Leverage comes from loans, and today we've got the first of a series of 3 consecutive episodes that focus on how you can best qualify for the mortgage loan that fits you. Today we're speaking with Ridge Lending Group's Caeli Ridge about investment property loans for 1 to 4 unit properties. That's single-family homes, duplexes, triplexes, and fourplexes that you do not intend to occupy. Now, you might remember that the first time we had a mortgage loan officer appear here on GRE, it was just 4 months ago on episode 40. But it's time to do another show about this because lending is such a key component to getting you into income property so that you can begin to build your wealth. Lending is also one of the more dynamic portions of the real estate investing industry. Caeli and I will probably have some overlap and review of that prior show, but we're also going to touch on some different subjects. She has agreed to go over lender closing costs with me line by line, okay? And I really want to help you demystify closing costs. Because when you get up from the closing table after you're done with your next income property loan, that should be a congratulatory experience for you, okay? Even a celebratory one. I don't want that feeling of yours to be diluted because you feel like you were confused about all those closing costs and you might even feel like you overpaid for something. So let's meet our guest. Caeli Ridge is the owner and CEO for Ridge Lending Group. She has spent the last 17 years as a nationwide lender and loan officer in both residential and commercial type properties. Caeli's also an established real estate investor herself, and she has held up to 42 investment properties at any one time in the United States. You know, I've told you before, listeners, how I really appreciate and seek out lenders that are investors themselves because they often understand you as a borrower better. Caeli's worked with thousands of real estate investors and homeowners all over the country, and she really has a proven track record of having helped more families realize their dreams of financial independence through real estate investing than any other mortgage lender in the country. She maintains and serves her real estate investor database of 30,000 strong and growing, and Ridge Lending is the preferred lender for over 4 dozen investment networks nationwide, making her company a true leader in real estate lending. I just look at the Ridge Lending Group logo. I'm actually looking at it right now. Beneath the art logo is the name Ridge Lending Group, and below Ridge Lending Group in the logo, it says, "Our knowledge and experience, your financial freedom." I mean, listeners, how often do you hear your mortgage loan officer even say the word financial freedom? Well, Ridge Lending Group has your financial freedom right there with the logo. So Caeli is really an industry leader as an educator to her clients within the lending industry, and she's really a leader in technology too. So that's why today it's my pleasure to welcome to Get Rich Education, Caeli Ridge.
Wow, thank you so much, Keith. What a gracious introduction. I appreciate it very much. I'm excited to be here, and hopefully I'm able to impart some valuable information to your listeners.
Yeah, well, it's great to finally have you. You know, lending is one of the most dynamic parts of the industry, so really what's taken place in the lending industry overall, I guess we'll just call it this past year, especially with respect to, are things getting more rigid or more lax for borrowers?
Yeah, I would say definitely more lax. I would equate it to looking back, I don't know, 6, 7 years ago. And I often say it was like fogging a mirror to get a loan. You'd have to have a
Right.
pulse and you could go to the bank and get a loan. Once the collapse and the start of recovery happened, we were supplying DNA samples to make things move. So it was a it was a severe 180. I think that in the last year, maybe 18 up to 24 months, we've started to see the writing on the wall is becoming a lot more aggressive in terms of what product availability is out there. The guidelines are loosening. So definitely as we move past the 2008, 9, and 10, we're finding that the lending side is becoming a lot more reasonable. Now, I want to be careful to say that that doesn't imply that the process is seamless or painless by any means, but definitely it's improving.
Yeah, as I like to say it, we saw coming out of the mortgage meltdown after 2008, 2009, where previously you only had to prove that you were alive. After the mortgage meltdown to get a loan, they're almost checking your genealogy and your family tree to make sure everything's okay. And you think now the pendulum is starting somewhat to swing back from that rigid environment.
I would still equate it, I'd say it's still 5 steps backward, 2 steps forward, but
Yeah.
we're making progress for sure. And we make jokes about, supplying DNA and genealogy grids and charts, but it almost feels like that sometimes. I have a fun analogy of turning a battleship in a creek, which is especially as we talk about non-owner occupied type financing, it's very different than a primary residence type loan. So it does feel overwhelming for some people. And I think that we've done a good job of helping hold our investors' hands in education. And really why I like your platform so much is because it's so education focused. And we take pride in the same principles here at Ridge.
Okay, so Caeli and I today, we're discussing conventional financing of non-owner occupied properties here, investment properties that you're not going to live in. And we're talking about 1 to 4 unit properties. That's single family homes, duplexes, triplexes, and fourplexes. And Caeli, there's kind of a difference in how a loan is structured after you own your first 4 properties, from properties 5 to 10, and then beyond 10 finance properties. Can you talk about those differences and those qualification requirements for each?
Absolutely. And actually, I'm glad you brought that up. So, per qualified individual, Fannie Mae and Freddie Mac, those are the conventional loans, allow up to 10 finance properties. We refer to those as the golden tickets. These are going to be the highest leverage at the lowest interest rates literally on the planet. And as such, when you're looking at the full 10, there are 2 very specific underwriting books that we have to adhere to from Fannie Mae's perspective, depending on where you are in the 1 through 4 finance properties or the 5 through 10. And as that relates to qualification, we can potentially talk about some differences in the 1 through 4 guidelines and qualifications versus the 5 through 10. There's some important details to share there.
Yeah, let's do that.
Okay. I would say in general terms, when underwriting a loan specific to an investor loan, there's 3 criteria that are most heavily weighted. Those are going to be your credit score, your assets, and your debt to income ratio. Now, for purposes of efficiency, I think we'll focus on the credit score and the assets, and maybe some other time follow up on debt to income ratio, because that gets a little bit more complicated. But
Okay.
as it relates to the 1 through 4 and the 5 through 10 books of guidelines, let's focus on credit score first. So in loan spots 1, 2, 3, and 4, there's really no hard and fast rule to credit score. There are things that we call compensating factors, like strong assets or low debt to income ratio, that can allow someone with a lower credit score to still qualify. I've seen as low as a 650 middle credit score be approved in loan spots 1, 2, 3, and 4 with those compensating factors. Now, what happens, however, is when we get into the 5 through 10 loan spots, they raise the bar on us a little bit. So the kind of vague rule in 1 through 4 becomes a hard and fast in the 5 through 10 loan spots, and you must maintain a minimum middle credit score of 720 or greater in order to qualify in the 5 through 10. Pretty straightforward. Moving into the reserve requirement of the guidelines, in 1 through 4, the reserve requirement on a single family to 4 unit property is 2 months worth of PITI, right? That stands for principal, interest, taxes, and insurance.
Right.
2 months PITI of the subject property plus another 6 months PITI on each subsequent rental property only in those first 4 loan spots. The primary residence will not count in that formula. Once we get to the 5 through 10, likewise with the credit, they raise the bar on us, and it becomes 6 months PITI on all rental properties. Make sense?
Yeah, that makes sense. Now, that can become a real headwind with the reserve requirement, but can you use some percent of retirement funds toward the reserve requirement?
Yes, I'm glad you asked that. So there's 2 different types of assets that are actually looked at and allowed, the liquid and the non-liquid. You're referring to the non-liquid, that we would call it non-liquid. Those are the retirement accounts, 401k, self-directed IRAs, full life insurance policies, and those are applicable to use for the reserve requirement. However, we're only going to be able to take a portion of the face value of the asset. Let's use 401k as an example. We can use 60% of what the face value is. So if you have 100,000 in your 401k, 60,000 of those dollars would be admissible for satisfying the reserve requirement.
Okay. It's probably a lot easier for people to come up with that than to show that much liquidity in a bank account, 6 months reserves on all properties if you're trying to qualify for your 5th through 10th property.
Right. And again, the primary residence does not go into that equation. So you'd find that it's rather reasonable when you end up doing the math, especially with the median price point of properties now in this particular real estate cycle. You assume 80 to maybe 150 on a single family residence. But when you do the math for what the mortgage payment equates on that loan size, times 6 months, times 8, 9, 10 properties, it's really not as much as it might sound when we're just sitting here talking about it. Unless the exception to that might be if you've got some 4-unit properties that are the $300,000, $400,000, $500,000 mortgages, then it can start adding up. But overall, I mean, they'll have the math, so they'll be able to kind of look at their REO and figure out what their total PITI monthly payments are and just multiply times 6, and that'll get them the reserve requirement number.
Okay, so the primary residence does not count in your property count 1 to 4 or 5 to 10, is that right?
No, it does count as, if it's got a loan on it, it will count as one of the 10 conventional loans, but it is not required to be part of the reserve calculation. So if you have a principal residence that has a $2,000 a month PITI, for example, that $2,000 will not be included in the 6 months worth of PITI for the reserve.
Got it. Okay, that's where the primary residence is excluded. And then there's a break between 1 and 4 finance properties and 5 and 10 with respect to the minimum percent down. Can you tell us about that?
Yes, very, very good question. So in loan spots 1, 2, 3, and 4, you're going to recognize a higher leverage opportunity. It will change depending on the property type. So for single family residents, the maximum leverage in loan spots 1, 2, 3, and 4 is actually 85%. Most people are surprised by this. 85% is available on single family in the first 4 spots, but it does come with an added PMI factor.
Right.
PMI, right? So private mortgage insurance will also be included on that loan, and the interest rate will be slightly higher. However, if you look at the math side by side between, say, 20% down, which excludes the PMI, versus 15% down, the factor is relatively low. So I would caution people not to totally rule out the 15% down option until they've looked at the math. If their resources are limited enough that it would allow them to get into 2 properties versus 1 property, the 15% down may be a special advantage they can take advantage of. 2 to 4 units do not qualify for the 85%. So going back to the original question, leverage opportunity, single family residence, 1 through 4, 85% max loan to value, and 2 to 4 unit properties, 75% max loan to value. When we move into the 5 through 10 spots, you're going to lose approximately 5% in leverage in each category. So for single family residents in loan spots 5 through 10, we're now limited to 75% max LTV, and the 2 to 4 units are now maxed at 70% loan to value.
Okay, so just to review, and I'm going to use percent down, which is the inverse of loan to value here to describe this. In your 1st through 4th properties, if you have a single family home in any one of those, you need 20% down minimum if you don't want to do the PMI thing with 15% down, or it's going to be 25% down on duplex, triplex, or fourplex if they're your first 4.
Exactly right. Very good.
And then 5th through 10th finance properties, if it's a single family home, it's going to be 25% down. Duplex, triplex, or fourplex, it's going to be 30% down.
Nice work, Keith. I'm impressed. Retention is very good.
All right, but we do have another break, though, when we go to more than 10 properties, right? How does it look for financing those after we're beyond, I think, what you called the golden ticket properties?
Right. So when we exceed or we've exhausted all 10 of the conventional loan spots, we move into the specialty type financing. This product was launched officially in February of this year, and it was designed to help investors in two ways. One, those that have exceeded the 10, and second, those that may not qualify for conventional by means of maybe slightly damaged credit and or inability to show enough income where their debt to income ratio is a little askew. We can maybe talk further on those details, but specific to your question, the 11 through 35 loan spots specialty fits into. It's an asset-based underwrite, which means we're really focusing exclusively on the property's qualifications itself. It leverages to 75% LTV, assuming that the property's debt service ratio is in line with what the allowance of guidelines are, up to the 75% LTV. Did that answer the question?
Yeah, I think it did. So, okay, so it's still quite possible and potentially feasible to qualify those, but rather than looking at the borrower for qualification, they're looking more at the asset.
Exactly. And there's a whole matrix that goes into how to quantify that. It's not as complicated as I may be making it sound, but yeah.
Is there typically a higher interest rate associated with the 11th through 35th finance property?
Absolutely. So this is still a 30-year fixed, which makes it unique. Most of the products that were available prior to February of this year that might have allowed investors to keep going past 10 were all adjustable rate mortgages with, just as high interest rates. But this is a 30-year fixed, and the interest rates you can expect are going to be a range. There's a lot of variables that go into equating the interest rate, but currently the range is anywhere from 6% up to 7.5%.
All right, well, that's a really good overview of what it takes to get into properties, and boy, up to 35. That's fantastic. Now, does any of this apply to foreign buyers of U.S. income property? We have listeners in over 140 countries, so.
We had a foreign national product. Unfortunately, at this time, it is unavailable. We're hoping to see it revived again 1st of 2016, but as of this moment in time, no.
Okay. Now, there's one other thing I wanted to ask about. Recently, I had a guest on my show. He's an author of a popular book. He even has a chapter in his book called Go Variable, Young Man. And what he likes to do is get LIBOR, LIBOR, London Interbank Offered Rate, variable interest rate loans, because apparently he's finding interest rates lower than 30-year fixed. And he knows specifically what he's doing. And he's basically arbitraging the difference. And I hear about people doing this from time to time. You have any comments on the LIBOR or how people are using that these days, Caeli?
I think in general, the idea of the adjustable rate mortgage for creating higher cash flows is a good one, especially if you're going to continue to potentially sell and or refinance those loans into new loans or selling them into 1031 exchange positions. In my experience, and I have to admit that it's probably been a good 30 days since I've looked at this, but up until the last time I checked, the fixed rate mortgages versus an adjustable rate mortgage for conventional products, right? This is the Fannie Freddie stuff, 1 to 4 units,
right?
We're on an inverted yield where, and even if you could find an investor that was offering an adjustable rate mortgage with the LIBOR index, which wasn't always easy, but if you could, the difference in rate between the 30-year fixed or fixed rate product and an ARM product, the ARMs ended up pricing out worse in interest rate than the 30-year fixed. So there was no incentive to look at the adjustable at that time. It's a good question. And if you've got reason to believe otherwise, I should probably take a quick check. It doesn't come up very often. Everybody is pretty fixated on needing and wanting the 30-year fixed. But if that inverted yield has changed, there may be some opportunity to review and or discuss that again.
Yeah, well, when fixed interest rates are this low, it's pretty difficult to refuse a sure thing too. So, leaving that, and one thing that I like to do when I buy property, and sometimes I encourage others to do this, is what I like to do is maximize my cash on cash return and minimize my money out of pocket so that I can buy more property. And I do it in this way. What I often do is I offer more than asking price for a property, and then I get that same overage as a closing cost consideration from the seller. So, just for example, if a rental property has an asking price of $100,000, I might offer $102,000. And then I get $2,000 of my closing costs paid for by the seller so that I can retain more cash. Do you see any limitations with that strategy? I know certain states have certain rules on this and such.
First of all, I think it's brilliant. I love that philosophy. I've used it myself 100 different times,
Good.
and I subscribe to it fully. The only caveat to that I would say there's two things actually. As long as the appraised value is there, so if the purchase price is $100,000 and it ends up being $102,000 for the credit, that's not a problem as long as the appraisal comes in at the 102. So you've got to be sure of that. And then the only other piece that I would offer is that the maximum seller paid contribution on an investment type property is 2% of the purchase price. We can't exceed that amount. So within the confines of conventional underwriting, just know that the 2% is the max when you're doing that math.
Okay, so actually just coincidentally in that example I gave, offering $102K for a $100,000 property, that's the maximum concession that I could get.
Right. And I think it's a fantastic way of leveraging further and keeping as much of those disposable dollars for future purchases as possible.
Yeah, for sure. Some choices are just easy. Some borrowers don't even realize that they can live in one state and get a loan in another state. So does that work pretty seamlessly? Are there any limits there? And then how many U.S. states does Ridge Lending Group lend to, Caeli?
It is very seamless. I would say 98% of our clients are out of state from where I'm physically located, and they're all over the U.S. Independent of where they reside and where the property they're looking to purchase has no bearing or impact on the financing and or restrictions of financing. I believe last I checked, Ridge is up to 43 states approved to secure financing for. I know the ones off the top of my head that we are not in and have no intention of actually being licensed in are New York, Hawaii. I don't believe we're in Alaska, and I want to say South Dakota is another one. I think there are one or two other states that are on that list, but it's not going to be anywhere that our investors are looking to purchase or refi where the returns, the ROI and appreciation returns are substantial for investors.
Okay, so you mentioned New York, a very populous state, is one of those excluded states, but you just mean you're excluded from originating loans there. You can still have an investor borrower in New York that invests in Tennessee or Texas, right?
Yeah, thanks for clarifying. Exactly. We are not licensed to originate loans for properties located in the state of New York, but our investors certainly can reside there and purchase wherever we're licensed.
Okay, great. Now, some borrowers might not realize that there's kind of a minimum loan amount that a lot of lending companies will do because just to make it worth their time and economies of scale and such. And, a lot of the best deals are in, some of these low cost markets like Atlanta, Memphis, Jacksonville, Orlando. I mean, what's the lowest loan amount that Ridge can originate?
Another good question. $60,000 is our minimum loan size. Now, there have been exceptions made below the $60,000, as low as $50,000, but I should probably just less it as a 60. $50,000 on exception can be made, but most generally $60,000 is our threshold.
Okay, so at a 80% loan to value, that's about a $75,000 property?
Yes, sir.
All right, that would cover it. So you are able to originate loans for most investment properties then. So, well, that's great. This has really been helpful. But we're going to come back in a couple minutes and talk about closing costs. We're going to go over some closing costs line by line and kind of demystify some of the uncertainty that goes around closing costs. You're listening to Get Rich Education. My guest is Ridge Lending Group's Caeli Ridge. More when we come back. I'm your host, Keith Weinhold. Cash flow real estate investors nationwide and worldwide, this is Get Rich Education's Keith Weinhold. Forbes has rated Memphis, Tennessee as the #1 cash flowing market in the world. Our good friends at Mid-South Homebuyers have been Memphis's premier turnkey real estate provider for 14 years with a stellar reputation and an A+ rating with the Better Business Bureau. Owner Terry Kerr was born and raised in Memphis. Yeah, he knows the market and has renovated and sold over 1,000 houses in the Memphis area. Find out what their many repeat buyers already know Their houses are completely renovated, even come with a 1-year builder's warranty and a lifelong rental guarantee. They're a perfect fit for the first-time out-of-state investor or the seasoned investor diversifying their portfolio. Mid-South Homebuyers friendly staff makes investing easy. Learn more at midsouthhomebuyers.com or give them a call at 901-217-HOME.
Are you having a hard time finding great investment properties? Unfortunately, the best deals are rarely found locally. Successful investing begins with the right properties in the right markets. Norada Real Estate provides everything you need to invest in the best deals across the U.S. Our simple, proven system will help you create real wealth and passive monthly cash flow. Get your free copy of the ultimate guide to passive real estate investing at noradarealestate.com/guide. That's NORADA realestate.com/guide.
This is Rich Dad Advisor Garrett Sutton. To grow your wealth, listen to the always valuable Get Rich Education.
Welcome back to Get Rich Education with our featured guest, Ridge Lending Group's Caeli Ridge. Okay, Caeli, so you sent a good faith estimate over to me so we can go through some of these closing costs, prepaids, and prorations line by line, and you can give an explanation of just where that charge comes from. First of all, why don't you let our audience know what is a good faith estimate, or GFE, that they commonly say in the industry?
Absolutely. So a good faith estimate is an accounting of what charges are being collected both from a buyer and a seller, just a borrower in the event it's a refinance. And it goes through the assumptives of what the charges you expect to pay are going to be, all the way from origination charges, credit reports, appraisal fees, title, escrow, recording fees, transfer tax. I mean, the list goes on and on and on. Now, one thing I wanted to clarify, Keith, and I probably should have let you know this, the sheet that I sent you actually is called a fee sheet. This is a one-page document, actually, that used to be called a good faith estimate.
Okay.
The powers that be decided to replace this concise line itemized simple form with what we now call a good faith estimate, which is a 3-page document that lumps fees together and actually makes it a lot more confusing and less transparent, I think, for the consumer, and why I continue to use this fee sheet as kind of an initial quote or estimate, if you will, for my clients, even before we get started, just to set the appropriate expectation in a clear and concise way that they can understand. Of all the different formats of communicating what type of costs are going to be associated, what an approximate interest rate is going to be, this is the one that I like the best. I think that my clients would communicate the same. Any of my clients can expect initially to get a very clear estimate of cost and approximate interest rates on the front end prior to, actually getting started with pre-qualification and underwriting and things. So, yeah.
Yeah, it helps to know what to expect. And the cost sheet that you sent over to me, this example that you gave me, is for, it looks like a real purchase of a non-owner occupied property just on any street in Tennessee. And there's a purchase price of $140,000, 25% down payment. So that makes for a loan amount of $105,000. And just go ahead and cut in if I happen to say the wrong thing here. It looks like the estimated settlement charges, that portion for this loan is $5,779.
Correct. So maybe you've kind of clarified some of the baseline details of this, and I'll just jump in and go over some of the different pieces. We are quoting on this fee sheet 25% down, like you mentioned, an interest rate of 4.375. This is a 30-year fixed mortgage. And yes, the settlement charges at 5,779 is a combination of origination points. You've got underwriting fees in there. You've got appraisal costs, title work, transfer tax. Now, some important note to make there is that different states and counties are going to impose different settlement charges, because Missouri, for example, doesn't have a transfer tax, whereas Tennessee has a nice hefty one. It'd be important to communicate to investors that, a fee sheet or a good faith estimate, they're not all created equal, and they will vary based on a variety of variables, one of which will be the state and county in which you're purchasing. A few others are going to be your loan size. Some of the charges from third parties are based on by the thousand in dollar amount. So that can vary with some of the title charges. Loan to value will also play a role because your loan amount is going to be dependent in some of the costs are going to be based on the actual loan size. So 75% versus 80% is going to yield different costs associated. So if you're looking at comparison side by side, make sure that you're comparing apples to apples. My background in being an investor and what I feel is a pretty deep understanding of finance, I've had a lot of time to, by trial and error, figure this out for myself. But our philosophy is as follows. As a company, we charge 2% or $1,500, whichever is greater, on all non-owner occupied transactions of loan sizes 150 and below. Now, the reason that we do this is a fewfold, and I think it's important to just address very quickly.
Okay.
I like the transparency. I have no problems in disclosing to our clients what we are going to be, what our compensation is going to be. I like the fact that it's going to be the same for Mr. Smith to Mrs. Jones and everywhere in between. But most importantly, if this is a long-term buy and hold investment, this would be a different conversation if this were a flip or a shorter-term investment. But for a long-term buy and hold, if you look at the difference between paying, let's say, 2% origination and yielding a 4.375% interest rate, as is listed here on this fee sheet that you and I are looking at together, versus paying 0 points and potentially a 4.7, 4.8% interest rate, and figure out the difference in monthly payment between those two interest rates, take that difference and divide it by the origination charge, you're going to find that on the average nationwide loan size that you're repaying that cost in monthly savings, typically within the first 36 to 60 months of ownership. So again, if we're talking about a long-term buy and hold, it really makes more sense to yield the lower interest rate and pay the points up front. Secondarily, although it's not as compelling an argument, but it's still something that needs to be considered in this conversation, points on an investment property are tax deductible. So that's something else to put into the conversation.
So we basically have what I would call a break-even point of 36 to 60 months, which is 3 to 5 years, when you pay an origination fee of 2%, 1% of that, which is an origination fee, and the other, which is a discount point, which just bought down your rate. Did I say that right?
More or less, yes.
So that is a $2,100 charge there on that first item, which is 2% of our $105,000 loan amount.
Right. And when people will look at that, oftentimes I'm explaining that portion of the fee sheet quite regularly. But again, the math is the math. There's no smoke and mirrors here. The transparency is something that I value. And it'll be up to the individual on how they want to exercise that, whether they want to take the higher interest rate or whether they would rather pay the interest rate or pay the origination and take the lower interest rate will ultimately be up to them. The math is the math. I promise you, though, that the competitors are making a minimum of 2 points and probably closer to 3 and 4 points. The consumer just is not aware of what's going on.
Yeah.
In terms of the actual closing costs, some things just to reiterate, just be prepared for differences in the recording costs, potentially the transfer taxes that we already commented on. It may or may not be applicable to any given state or county. Escrow charges, appraisal fees, those are typically going to be a little bit higher than a primary residence because they come with some additional schedules like an operating income statements. So just so that you know, the appraisal fee on many cases, people ask, why is it so high? The reason for that is there's some additional data in there that we have the appraiser give us for qualifying an investment loan. Mobile notary is often a fee on there that people question. Obviously, if the property is in Tennessee and you live in California, we're going to have to arrange to have a mobile notary come to you to sign your loan documents at closing.
Okay. And we have a $175 mobile notary fee for that service on here to mention that. The appraisal fee is $650 on this sheet. And in most states, the appraisal fee is something that the buyer pays, right?
Correct.
And then we have, I'm just trying to take a look at this going down it line by line. We have a $75 tax-related service fee. What is that?
Yeah, good question. So that's to set up the escrow account. It's pretty standard. It typically, and the fee sheet's going to be a estimate. I want to stress the fact that it is an estimate. I tend to be on the high side when I put these together. Tax service fee is for establishing a one-time fee for establishing the escrow account that you're going to have with your mortgage. So in addition to paying your principal and interest, you're also going to be paying monthly the taxes and insurance. So establishing that account, the tax service related fee is what that's for.
Okay, and then there's a processing fee of $790 on this rate sheet. What does that refer to?
That is Ridge's fee, actually. That's our processing fee. That and the origination points are our compensation.
Okay. And let's just keep in mind, listeners, this is a company that you're doing business with, and people with expertise are going ahead and expending their labor and their knowledge on this. So, this is a business. So this just allows you to make comparisons out in the marketplace, okay? And you really need to be careful comparing apples to apples rather than apples to oranges, okay? The next thing we have is an escrow/closing fee, and that's $550. What does that refer to?
So the escrow company that is selected, typically on a purchase transaction, it's going to be the seller that directs who the escrow company is. The escrow company is going to be the individuals that supply us with our surveys, our preliminary title reports. They're going to be the individuals that set up the loan documents, that fulfill our lender instructions on how closing needs to take place, different tasks like that. Typically speaking, that fee can range anywhere from $350 to $550, but because there's enough variance there, I usually keep it on the fee sheet on the higher end of the $550.
Okay, and then the next item is title insurance estimated for $250, and then after that there's owner's or seller title insurance for $567. What are those two different title insurances referred to, and why don't you just go ahead and give an explanation of title insurance as well?
Sure. So title insurance, it's for everyone's benefit ultimately. But for the purpose of securing a loan, we will not close until we know that there is clear title. And by clear title, that just means that there's no judgments, liens, clouds on title that would potentially put our loan in second lien position. We need to make sure that the loan that we will be securing for you is going to be in first lien position so that in the event of default, we are going to be the first people that get paid. So the title part is important, especially for those reasons. Now, on a purchase transaction, the owner's title policy is paid by the seller in most cases. Now, I have seen it written in contracts where the seller is putting that on the buyer's side. So that might be something for your investors to double check in the contract, the language that may pertain to the owner's title insurance, and make sure that it's really the seller that's responsible to pay for that. Reminder, though, on a refinance transaction, when we don't have a buyer and a seller, it's the borrower that's responsible to pay for all of the title costs. So you'll notice that anyone that's done a purchase and a refinance inside of the last however many months, that the actual title insurance policy is a lot more expensive on a refinance than it is on a purchase because you don't have the owner paying for the lion's share of it.
Okay, and then the next one is an underwriting charge of $895. What does that refer to?
That's the investor's underwriting fee, pretty standard in the industry, just for underwriting and clearing conditions for the loan and setting it to closing. They're going to go strictly from the Fannie Mae underwriting guidelines and gather and collect all the necessary documents, review, typical underwriting process stuff.
And second to last significant charge we haven't discussed is recording fees of $215. Now, is that like a third-party fee that the municipal recorder might be charging and are just passing along, or is that something else?
Exactly, yes. Third party, that's going to be specific to the county and what their charges or fees will be to take the applicable mortgage instruments and record them with that county to ensure that the appropriate documents are filed, recorded, et cetera, that put you as the recorded owner. The mortgage details will be in there. All of the legalese documents will be recorded with the county, and that's what those charges are. Those also vary significantly from state to state, county to county.
Okay, and the last significant charge we have on there is $686 for a county transfer tax. We already touched on that somewhat. That can vary quite a bit by state and county, and that brings us to our total of $5,779 for a $105,000 loan, and over $1,000 of that $5,779 is to go ahead and buy down your interest rate. So, any other thoughts about the cost sheet before we move on, Caeli?
I think we covered it. I mean, just to reiterate, the origination point specifically, reminder, this particular example yields an interest rate of 4.375. So I think the one thing I'd want anyone to take away from this is just make sure in comparing like you had mentioned, Keith, that it's apples to apples, that the criteria that is being quoted on is the same from one company to the next. Ask the transparency questions about points and all of the line-by-line items that we just talked about.
Well, that's great. Well, I give you a lot of credit for coming on and talking about it line by line like this. I don't know that everyone would want to do that. Well, just kind of in winding down here, Caeli, is there really anything else that my listeners ought to know as prospective borrowers about the lending industry today?
I think that doing your due diligence and being as educated as you can is something that we try to focus a lot of attention on. That is my best advice, is not just assuming when you're talking about the financing. It can be such an impactful piece to this orchestra in optimizing the return that you really want to understand, at least from a 30,000 foot view, what the financing really consists of, some of the why behind the how.
Well, that's great. How can my listeners find out more about Ridge Lending Group?
One of two ways. They can go to our website, www.ridgelendinggroup.com, or they can call us at 855-74-RIDGE. If they'd like to email, actually, there's a third way, info@ridgelendinggroup.com. They can reach us that way too.
Well, that's fantastic. Again, the only lender I have ever seen with your financial freedom right there as part of the tagline in the logo. Caeli Ridge, thank you so much for coming on to Get Rich Education today.
Thanks, Keith. I really appreciated being here.
Well, that was great. As far as I'm concerned, Caeli is a star in the lending industry, and she really gets it as far as what investors specifically need in a loan versus what owner-occupied homeowners are looking for. Through her lens, 85% loan to value, meaning just a 15% skin in the game portion for you, and bringing on a small PMI premium for you is worth it in order to get into income property. That's going to depend on you, and it depends on running the numbers both ways, and Caeli's company runs those scenarios for investors like you so that you can decide. Again, her company's website is ridgelendinggroup.com. Of course, that type of information and other good info is in each episode's show notes here as usual. All right, so this show focused on investment single-family homes, duplexes, triplexes, and fourplexes. On next week's show, we're going to host a distinguished guest that helps investors originate loans on larger properties, apartment buildings of 5 units up to buildings with hundreds of units. Yes, as an investor myself that's owned plenty of both types of properties, there is a significant divide in lending guidelines between 1 to 4 unit properties like Caeli and I discussed, and 5+ unit properties like we'll discuss next week. And then on the show 2 weeks from now, I'm going to feature another credentialed guest whom can tell you what your options are outside of qualifying for property conventionally. After listening to today's show and next week's show about apartment building qualification, he'll tell you how to finance creatively, but you're going to have to get more resourceful and learn some new skills for that one, okay? Hey, special thanks today to the talented Caeli Ridge and Ridge Lending Group. I've really enjoyed talking to Caeli before I hosted her on the show. She's a person that's really closely aligned with my investing style, how to allocate capital prudently while being risk-aware, cognizant of opportunity cost, and using an abundance mentality to invest in real estate for an outcome of lifestyle improvement. For Get Rich Education's developers, John Collins, Marcus Whelan, our sound engineer, Vidran Jampo, designer, Nikon Roy, I'm your host, Keith Weinhold. Don't quit your daydream.
You've been listening to Get Rich Education, telling you what the wealthy won't tell you about real estate and investing. If you enjoyed the show, please take a minute to visit iTunes and leave your comments.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.